Hello and welcome to this week's show. Thanks so much for joining us today. I'm your host Trey Winowitz and you're watching Right on the Money. Our goal for the show is to always equip you, the viewer, with accurate financial information so you can make educated decisions for both you and your family. Now we've got a great show lined up for you today, so thanks for watching. We're going to be tackling some difficult financial questions and we want to take some things that could be somewhat complicated and make them simple and easy to understand. So come on in and have some fun with us today.
In the aftermath of Hurricane Katrina, Trey Winowitz was forced to move himself and his family over 600 miles north and begin his financial planning practice again, from scratch. Since then, Winowitz Financial has become a national success story, establishing itself as a trusted source for financial advice in and around East Tennessee. In return, Trey gives back to the community by sponsoring monthly educational workshops and annual charity events. He also hosts a weekly radio show informing and entertaining those in need of financial advice. So, if you'd like to understand more about today's challenging financial environment, if you'd like to overcome your current financial situation, and want to learn from someone with a track record of overcoming, stay tuned for some trusted financial advice that's right on the money.
Now let's get back to today's main topic, stock market history. You know, I get questions all the time about how the market's doing or what I think the market's going to do in the future. And most of you viewers out there understand that no one has a crystal ball.
I have one.
Really, Stephen? That's not going to help you in today's market. Well, most people don't have a crystal ball. But what we can do is look at the trends of the market in the past and see if we notice any patterns emerging. This will help us analyze the current cycle and position ourselves as well as our clients for what may happen in the days and months ahead. Often when I teach public workshops or speak as a guest at a special event, a lot of times that's a church or some other organization, the topic of the stock market and its cycles that it goes through typically generates a lot of discussion and response from those listening. The reason is, as most of our viewers know, we're in a volatile time and a rapidly changing environment. There are many wild swings in the market, and a lot of times we hear from our viewers and those who attend our seminars that they feel like they're always in a recovery mode. They're spending too much valuable time recouping old money and hardly any time making any new money. This is why I think it's very important to understand what the market's done in the past, but more importantly, asking the question, what else was going on during those periods that may have caused the market to stay in a particular pattern or cycle? So now we're going to take a quick break, and when we come back, here's what we'll be looking at on today's show. Major market cycles of the past, how the history has affected those cycles, what cycle we might be in now, and how to succeed in today's market. I hope you can stay with us. This is going to be a great show. Stay tuned for more trusted financial advice that's right on the money.
For the last few years, it's been harder to make a consistent return on your money. Are you paying too many fees? Could you get cheaper life insurance rates? Could you pay less taxes? Join the hundreds of others that have dramatically saved money using a free fee analysis. That means you've got to make sure your money is working efficiently for you. Call Winowitz Financial today, 691-2433. That's 691-2433, and start saving money today.
Thanks so much for joining us. I'm Trey Winowitz, and you're watching Right on the Money. If you're just tuning in, we're talking about the history of the stock market today and the cycles that it goes through. If you haven't caught the whole show, please visit our website at treyw.tv, where you can watch all our old shows and catch up on what you've missed. Also, there's a lot of great resources there, and it's a great way to send us your questions and try to get them answered right here on the show. Now, getting back to our main topic. When I look at the history of the stock market, I see two major trends. Stock market cycles tend to run in 16 to 18-year cycles. Generally speaking, the economy is either on an upward trend or it tends to be in kind of a sideways trend. And by the way, historical numbers that we'll be referencing on today's show are going to be brought to you by StockCharts.com. Now let's take a look at some historical cycles and how we've arrived at today's stock market cycle. The first cycle I want to talk to you about is 1930 to 1948. So if we look at what happened in 1930 to 1948, the stock market was in a flat cycle for about 18 years. But historically, what happened in 1929?
The stock market crashed.
That's right. And after the stock market crash, it started the Great Depression. So as an investor, if you put $100 into the stock market in 1930, it would have roughly taken you until 1948 to get your $100 back. But in 48, the cycle changed again. And in 1948 to 1966, we had an upward trend in the stock market. Now, historically, what happened in 1945?
World War II.
That's right. And after wars, uncertainty is removed from the stock market. We became a manufacturing nation again. The stock market boomed, and everything was good from 1948 to 66, which was roughly about 18 years. Now, after the break, we're going to talk about the next two stock market cycles and bring us up to today's situation that we're in. Stick around for more advice that's right on the money.
Are you planning for retirement? Which path should you take? How can you avoid mistakes? What about a second opinion? Get sound advice for today's market. Make sure your future is secure. With principal protection, reasonable returns, simplicity and safety, call Winowitz Financial today to schedule your complimentary financial review at 865-691-2433.
Thanks again for joining us. I'm your host, Trey Winowitz, and you're watching Right on the Money. Today, we've been talking about the history of the stock market, and if you haven't caught the whole show, please visit my website at treyw.tv, where you can watch all our old shows and even catch up on what you might have missed in the first few segments. So back to our chart here for some more stock market history. In the previous segment, we covered the first two cycles of the stock market. From 30 to 48, the stock market was very flat. That was during the Great Depression. In 48 to 66, the market was on an upward trend, and that was after World War II. Next, in 1966 to 1982, the stock market was flat. In 1966, the stock market was historically at about 1,000 points in the Dow. Oddly enough, in 1982, the Dow was still at 1,000 points. Now, this was a unique time for our economy. We had what was called stagflation. That at the time wasn't even a word that was invented. It was made up of two terms. We had a stagnant or a declining economy, while at the same time we had what?
Inflation.
That's right. And the other couple of key factors that caused the market to be flat were at the same time we were at war, and then we also had record gas and oil prices that were rising through the whole time. So in 1966 to 82, kind of like the 30 to 48 period, if you would have put in $100 in the stock market, it would have taken you roughly 16 years to get your $100 back. But in 1982, everything changed, because from 82 to 2000, we had the biggest bull market in the history of the stock market. We went from 1,000 to 10,000 in the stock market. That's over a 1,000% return on your money. And throughout that time period, I believe, as an advisor, most people that I talked to either started following the stock market or started putting money into the stock market during this time period. I also think this is where Wall Street came out with a lot of their famous psychologies about how they wanted investors to believe that they should invest forever. Things like, we're in it for the long haul. Over the time, the stock market outperforms everything. Well, when the market's going up 1,000 points, or 1,000% from 1,000 to 10,000 in 18 years, it did outperform everything. They convinced us over this time period, too, not to worry about losses, that whatever happens, the stock market's always going to come back. Well, in that 18-year period of time, that was true as well. But in 2000, the stock market cycle changed, and it's not been the same ever since. So from 2000 to present, investors have been a part of two once-in-a-lifetime market corrections. In using traditional strategies, most of you out there have spent the last 10 to 12 years recovering your old money and not making any new money. This has forced
many investors out there to examine these strategies that worked well in the 80s and 90s to see if they're still working today.
So my question for you, as I look at the past cycles, is what do you think the stock market was supposed to be doing? Did all the different crises in the last 12 years cause the market to be flat? I believe it was supposed to be flat, and all the different crises that we've seen have just been prolonging the cycle that we were supposed to be in. A smart investor realizes that success today isn't always about making the highest possible return. Guys, the 80s and 90s are over. I think success today is defined differently. How can you, as an investor, make a fair and reasonable return when the market is good and not lose your shirt during the next market correction? One last thing I want to highlight before we get to our bottom line. How many things out there are affecting your investments that you have no control over? What do you think will happen if Iran bombs Israel? Oil prices continue to rise above $5 a gallon. What if we have another terrorism attack? What about other natural disasters, other crises? European crisis continues. And what about the things that we can't even think of today? Is your retirement protected from the next problem? Is it guaranteed? What I want to do is give you an opportunity to always have your money protected so you can avoid those situations. Now, we've covered some of the past stock market cycles, and in conclusion, here's our bottom line. Traditional strategies have not worked as well today as they did in the past. Today, I believe you need to avoid losses, not just spread out your risk. You got to seek out reasonable returns and don't lose money. Coming up next, learn how people just like you have benefited from a no-cost second opinion. Stick around and don't miss our Money Matters segment.
Are you looking to recruit and retain great employees? Would you like to reduce your retirement plan cost? Now you can offer employees the opportunity to keep their retirement funds protected and growing. Separate yourself from your competition. Make a difference in the retirement of your employees with little to no additional cost to you and no change to your TPA, payroll, or existing 401k company. Call Winowitz Financial today to find out more about this exciting new product.
I don't know about you, but what's been going on in the U.S. economy, and especially Europe, scares me. There are too many things that we can't control affecting our investments. We have to do our best to educate ourselves about the best options out there to protect our nest eggs. The best way to do that is to call Winowitz Financial and reserve a seat at their next free educational workshop. There's usually a waiting list for these, so call today to reserve your seat. 691-2433. That's 691-2433.
Now that we're back, I'd like to tell you about some real-life folks that you may can relate to, because it never hurts to have an extra pair of objective eyes take a look at your situation and see what can be improved. Even if strategies that you're using can't be improved on, sometimes people say it's a huge comfort when I tell them that what they're doing is working well, or maybe they should continue on the same path. However, in some cases, we discover that some of the products or strategies they thought worked in a certain way actually don't. And sometimes not getting a second opinion can be very costly. If you want to be a part of this Money Matters segment, please give us a call at the office for a complimentary review. As you'll see, everything's kept confidential, but your situation may help some of our other viewers secure their financial future. So give me a call and maybe your case will get picked for the show. I want to take a second to introduce you to some people who came into the office recently for a no obligation second opinion just to be sure. And these people were glad they did. So let's take a look at this week's case. Hey Jana, can you bring me my notes? Thanks. All right. Okay, our case study this week is a 75-year-old teacher who's retired and a 73-year-old manufacturing engineer. They're both from Powell, Tennessee. These folks came in after listening to our radio show and where we were talking about traditional diversification versus true diversification. So our main concerns, or their main concerns as they came into the office, were cost and fees. They weren't really sure how their current advisor, stockbroker, was getting paid or what they were paying him for that advice. They also had some low interest rate accounts, some CDs and other things that were renewing at very low rates, so they were concerned about that, making a reasonable return on those. And then also just principal protection. They were informed over the years that they had a real diversified and conservative portfolio. However, they had lost quite a bit of money the last time the market dropped, so they were looking for just some assurance that they were doing the right thing. What we did, our steps to success, kind of like with a lot of folks that come in, first we ran a fee analysis. We wanted to see, how much they were actually paying for the accounts that they had. Were they having accounts that were efficient, and were they doing what they wanted them to do? Secondly, we compared their goals and objectives for their money versus the accounts that they had. Did the accounts that they have match what they were trying to do with that money? And lastly, we shopped around for other secure, guaranteed alternatives to their CDs that continue to be able to keep their money liquid and available to them. Results were, after we looked over everything, we did a fee analysis, we identified that one of the annuity products that they had was actually a variable annuity. It was costing them about 3.5% per year in fees. They had no idea. So a lot of times that fee analysis is very, very beneficial. We were able to upgrade that account to something that was more suitable, that had no fees, and it was very, very safe, and just really did well in accomplishing their goals for that money. Other than that, we also realized that they really didn't have a lot of protection from stock market risk. They had some diversification, but basically their risk was just spread out. They didn't have anything that was helping them eliminate the risk for the market. So we were able to solve that and find some accounts that helped them achieve some consistent dividends and interest for their accounts. Lastly, we also repositioned some of their managed money or some of their stock market money to a new management firm who had a consistent track record of helping avoid losses when the market went down. So learning about this couple proves that sometimes the right second opinion can be well worth it. Give us a call today for a complimentary review, and if your scenario gets picked for the show, you're going to receive a Right on the Money prize pack. But most of all, we want to help you. Coming up next, another opportunity for you to be a part of the show. Post it on our Facebook, tweet us, or email us your financial questions, and stick around for the viewer mail section. Welcome back to Right on the Money. I'm your host, Trey Winowitz, and it's time for you, the viewer, to be an integral part of this show, Viewer Mail. This is the part of the show where you send us your questions about anything financial. In order to get your questions to me, you can post them on our Facebook page, tweet your question to me at TreyWTV, or email them to me at advice@TreyWTV. If your question happens to get answered for the show, you'll receive a Right on the Money prize pack just for your willingness to help out our other viewers. This package has a retail value of over $50, so please don't stop sending us those questions. Our first viewer mail question today is, my car insurance agent is trying to get me to buy life insurance to get a discount on my other policies. Is this a good idea? Now, every situation is different, but what I've seen personally is that when people come to the office with this question, we run them an independent quote with companies specializing in life insurance. When you do this and compare the cheaper prices of an independent quote, sometimes it could save you more money than the bundled discount from your current provider. But not always. Give me a call at the office and we'll run you the same quote, and then as always, you the consumer have all the information so you can make an educated decision. And our next question is, I'm 26 and recently married, and my wife and I are looking into purchasing our first home. Also, my best friend from college just got a job selling insurance. What kind of insurance do I need to buy, whole life or term? Now, that's a great question, and having learned a lot about insurance companies over the years, I'd say that it's a pretty common question in your situation. Insurance needs can only be determined after meeting with a qualified professional, but I can generalize based on the information you've given me. Probably just makes sense to look at some low-cost, guaranteed term insurance. And there's probably some other things that you could focus on at this stage of your life before looking at purchasing whole life insurance. As a matter of fact, give me a call at the office and I'll send you a free copy of our DVD about our life insurance show. detailing the different options just to help you. Thanks a lot for our Facebook post. The last question we have time for today is this. I'm 39 years old and my company matches up to 3% on my 401k. I was going to put in 6 to save more money. Is this a good idea? First of all, it's a great idea to put money into your company retirement plan, especially when they're giving you matching funds. Despite your age, whether you were 29 or 49, my advice would probably be the same. Fund the 401k up to the match, then look into start funding a Roth IRA. This is going to allow you to have some of your money accumulating on a tax-free basis. With our current financial situation, paying taxes now and looking into all the alternatives for after-tax money, I believe is a wise choice. There are many low-cost and no-fee options out there for accounts. Please give me a call if I could give you any help. Stick around after this short break for Right on the Street. See what some local people just like you think about the stock market and other financial topics. You may actually see someone that you know.
For the last few years, it's been harder to make a consistent return on your money. Are you paying too many fees? Could you get cheaper life insurance rates? Could you pay less taxes? Join the hundreds of others that have dramatically saved money using a free fee analysis. That means you've got to make sure your money is working efficiently for you. Call Winowitz Financial today, 691-2433. That's 691-2433, and start saving money today.
Are you planning for retirement? Which path should you take? How can you avoid mistakes? What about a second opinion? Get sound advice for today's market. Make sure your future is secure. With principal protection, reasonable returns, simplicity and safety, call Winowitz Financial today to schedule your complimentary financial review at 865-691-2433.
And we're back. This is Right on the Money, and I'm Trey Winowitz. See what some local people just like you think about the stock market and other financial topics. You may actually see someone that you know. Maurice, what's a bull market in relation to the stock market? What does that mean?
A bull market, just say, I don't really know.
Okay. Concerning the stock market, what is a bull market?
When stocks are doing really well.
That's exactly right. When the stocks are doing very well, so conversely, a bear market would be when?
When they're not doing so well.
Right.
Bull market's when people are selling.
Okay.
Bull market is something that you...
Can you make money in a bear market?
Yeah, if you qualify.
Okay, if you qualify?
Yes.
Good. That make a bear market?
When people are buying.
Okay. Would you think a bull market was a good thing or a bad thing? How about that?
No bad thing.
Okay. If you're using a buy and hold strategy in the stock market, when would be a good time to sell?
Let's see. Maybe in the summer.
Okay.
Well, that's a hard question.
Bonds. Are bonds safe?
Yes,
Okay. Can you lose money in a bond?
sure. You can lose money in anything.
What is a bond? Do you know what a bond is?
When you love somebody and unrepeatedly, maybe.
I like that. My wife and I feel the same way.
Yes.
Do you think you can lose money in a bond?
Yeah.
I agree. Well, how much risk should someone take with their money?
I think it depends on your age.
Okay.
I think the younger you are, you're okay with taking more risk in the stock market because you have a better chance to make your money back.
And how much risk should someone take with their money?
Well, I think that depends on the person. Some people are a little more willing to gamble than others.
How much risk should people really take with their money?
None.
I like that answer.
Well, when they get to the age of old age.
Old age? Okay.
I think you're asking me a lot of questions. Maybe I shouldn't be answering these questions.
No, these are all great. And can I borrow $20?
I don't have $20.
Okay, thanks. And last question, can I borrow $20?
No.
Okay, man. All right.
Thank you.
Thanks for joining us. And can I borrow $20?
Sure.
All right, thank you very much. That's awesome. One last question. You look like a very well-dressed and wealthy guy. Can I borrow $20?
$20?
Uh-huh. You got 20 bucks I could borrow? Come on, man. You got 20 bucks?
I don't have it then.
Okay, no problem, man. Hey, thanks for your time. And we're back. This is Right on the Money, and I'm Trey Winowitz. We're just getting ready to wrap up the show, but before we go, I'd like to tell you about an old Louisiana tradition called lagniappe. Lagniappe means to give someone a little something extra, and the way that we want to do that here at Right on the Money is to brighten your day at the end of our show. So with that, here's a little lagniappe for you. So Einstein dies. He goes to heaven, only to be informed by the doorman that his living quarters aren't yet ready. I hope you don't mind waiting in the dormitory, says the doorman. We're very, very sorry, but the best we can do is to get you a room that you have to share with others. Now, Einstein agrees, hey, that's no problem. No need to make a fuss. The doorman leads him down the hall, and they enter, and he's introduced to all his present roommates. Now, let's see. Here's your first roommate, and he has an IQ of 180. Einstein says, man, that's wonderful. We can discuss mathematics. And here's your second roommate. His IQ is 150. Einstein says, man, that's wonderful too. We can discuss physics, science, and things like that. And this is your third roommate, Mr. Einstein. His IQ is 100. Well, that's wonderful. We can discuss the latest plays in the theater. Now, just then, another man moves out to capture Albert's hand and shake it. I'm your last roommate, Mr. Einstein, and I'm sorry, but my IQ is only 80. Albert smiles at him and looks back. He says, so, what do you think the stock market's going to do? And that, my friends, is a little lagniappe for today. I want to personally thank you for watching our show today. I hope you found our show helpful as well as a little bit entertaining. If there's anything at all I can help you with financially, please don't hesitate to call our office. And remember, any plan that we come up with will always have three main goals for your money. Safety first, or protection of your principal, is always number one. Making a reasonable return on your money in what some would consider an unreasonable market. And number three, keeping your plans simple and easy to understand. If that sounds like something you want, I know I can help you. Also, please keep the financial questions coming. We'll do our best to get them answered on the show. I'll see you next week at 3 o'clock for more trusted advice that's right on the money.